For the next 45 minutes, I'm going to be talking about my favorite strategy, and that is credit spreads. At the end, I'm going to be giving you an offer, and my offer is free. It is free. I want you to sign up and get a lot of free education. I want you to hear from me. I want you to learn from me. I want you to know what I do. I want you to be in agreement with what I do makes sense to you. So take a deep breath, relax. Let's talk about credit spreads. The other thing is I've got the question box up right in front of me, and as I see a question coming through, I want to answer it right away. So don't hesitate. Go ahead and put a question in the question box. I'd like to get that answered for you right away so that you are not thinking about that question as I'm presenting additional material. Okay, who am I? I've been trading for about 35 plus years. I run a hedge fund, Options Infinity Growth Fund, LLC. And I've made my money, and I'm at the point in my life where I get a kick out of volunteering and teaching people who want to trade the market successfully. And that does not mean get rich quick. It means consistently making profits month after month after month. It means not taking a lot of risk. It means having a controlled strategy and following the strategy. And that's what I teach. That's what I teach. I am the creator of www.optionsinfinity.com. I believe this is the greatest stock education website out there. And you're going to see later on, I'm going to take you to that website if you don't want to, if you're not going to go between now and then. You'll see all the information I have there for free. I want to teach you, because the stock market, if you don't know what you're doing, it's going to chew you up. It's going to chew you up. I trade the stock market. It does not trade me. I do not take more risk than I feel is necessary. I am a consistently successful trader. And that's what I want you all to be too. And that's one of the reasons why I'm teaching this today, because this is one of my favorite strategies, credit spreads. Okay, so my agenda is, first of all, we'll be looking at the time value of the decay of options and how we can take advantage of that. And we're going to be looking at bull puts, bear calls, which are vertical spreads, and iron condors. And we're going to be looking at the advantages of this strategy. And how do you make money with credit spreads? There's three ways. You can make money if it goes in the direction you're looking for. You can make money if it stays sideways. You can even make money if it goes against you a little bit. It's a very conservative trade method. Now, a bull put is a bullish strategy. What we're going to be doing is we're going to be selling puts, but then buying them further out of the money for protection. We never want to sell naked. Yeah, there's a lot of money to be made there, but and you can win for months and months and months, and all of a sudden in 1 month you're wiped out. You don't want to do that. You don't want to do that. You want to be conservative here. There's money to be made. This is not an easy endeavor that you're about ready to do. And I know a lot of you might have been trading for a while and you're not successful. And one of the reasons is you got to stick with a rock solid strategy. You got to let it work. You got to adhere to the rules, and you got to be a conservative trader. I'm going to be talking about choosing the credit spreads that are really worthwhile. How do I mitigate risks? Then I'm going to be talking to you about a couple actual trades that have just been closed out this year. Talk about a bull put for for the RUT, where I made 125%, Google 160%, and Amazon 65%. And these were recent this year trades that I'm going to be sharing with you. I'm going to be going over some long-term trading results. One of my mentees actually went back 10 years, and he did some back testing, and he set it up according to the trading rules that I go over, and he came back with the results of 10 years worth of trading, and I'm going to be showing you that. It's pretty amazing. Finish up by talking about generating income and what is financial freedom and what do you really need. Okay, so that's what I'm going to be talking about. Then we'll go to my website and take a peek at it. Jurgen says, constant winners is what I want and need. That's good, but you got to accept losers. You got to be able to know that every system out there, every strategy is going to have losers. And you might even have a losing streak. And that's why you got to control how much money you put in. You've got to have risk management on your money. And on the website, I'll teach you for free for a given portfolio what is the proper amount that you should be trading. Okay? Losing is a very important. Learning how to handle losses, when to take losses, is a very important part. As a matter of fact, the last time I talked with investors in Inspiration was June 28th, and my topic was how to exit, either by taking a loss or taking a gain. And it was interesting to hear the previous speaker, Joe, talking about the Fibonacci's. I think the Fibonacci's it's one of my favorite forward-looking tools to know when it's about time to take that profit, if it is profitable. If it goes against you, I have rules on that too. But I love the fibs, and I really buy into what he was talking about with the Fibonacci's. Okay. Options decay. The time value of options rapidly decays, especially during the last 30 days before expiration. Okay, and this is an exponential curve, and you can see the last 30 days it really dips. So what we are going to do with credit spreads is we are going to be selling options. There's two ways that an option premium, if it has real value, that's one. The other is time value. Now, we're going to be selling out of the money options, so there is no real value. The only value there is time. And if the price stays stationary, that premium will decay, and decay very rapidly. And that's what credit spreads are all about, taking advantage of that. Now, the advantage of the credit spreads is you don't need to know the exact market direction. It has a little bit of play, and that's very important, because picking a market direction is extremely difficult, especially in the high volatile time period like we are right now. And most of the time the market is in high volatility. With this strategy, you can profit when the market goes up or it goes down. It's just a matter of changing the strategy. If you're bearish on it, you go in with bear calls. If you're bullish on it, you go in with bull puts. If it's going sideways, you can take advantage of both bear calls and bull puts and put in an iron condor, which gives you the credit for both. These are high probability trades. I'm going to go way out of the money. So the probability that it's going to get there is very low, and that gives you an advantage. This strategy is going to yield monthly income on a consistent basis. Yeah, we're going to have losers. But if we have consistent winners, you're going to have a consistent income with very low drawdown, which is very important when you're trading as a professional. You don't have to constantly watch the market. I've been doing this for 35 plus years. I do all my strategizing first thing in the morning. I get up, come down to my study. I like to look at, I don't like the talking heads, but I like to look at CNBC first thing in the morning, see what the market's been doing. I strategize and I plan for the day. I watch the market from the opening, from about 9:30 to about 10:30, then I go about my business. Come back and touch base about noontime, go about my business. I love to watch the close. The big boys are active during the close. It's very important for me to watch that. 3 to 4 is a very important time to watch what's going on in the market. That's all I watch it, and I'm a professional. Okay, I know a lot of you are out there. You know you're working for a living and you can't do that. Well, can you watch it a couple times during the day? Absolutely. Can you put this trade on, which takes about 5 minutes once a month? Yes. Okay. This is the system for you. It's low anxiety. It's low anxiety. It's not going to swing up and down and up and down and up and down. You're going to get good returns with controlled risk. Okay. These strategies, taking advantage of the theta decay, or an iron condor, a bear call, and a bull put. A bull put is a type of option strategy that's used when the investor expects a rise in the price. The operative word here is bull. If you're bullish on the market, then a bull put is a better trade than a call or buying the stock outright. Okay? And what we're going to do here is we're going to come down out of the money, and we are going to sell. We are going to sell an option. Usually I'm looking about 40 days from expiration. And then what we're going to do is we're going to buy one further out for protection. So my risk is this amount here. I don't have to worry about a catastrophic failure. I don't have to worry about a crash. I don't have to worry about anything because I've put on a conservative trade. This is the maximum amount I can lose. Okay? And I know that going in. Remember, a bull put, you're selling puts and buying one further out of the money. And it is a bullish strategy. Okay, here's a quick example. And this goes back to May of 2015. This example you just saw, the RUT was at, and I love the RUT, and I trade these on the big indices because you get more credit, and that's what's important. The RUT was at 1238. To set up a bull put, what I want to do is I want to come down here out of the money, and I want to sell a 1210 put. So I'm 28 points. The market can drop 28 points, and if it rebounds from there, I'm golden. That's awesome. Or if it goes sideways or it goes up. That's awesome. Now at the same time, now this is, you would get $20 here if it continued to go up if you sold this naked. Big mistake. Big mistake. That, you know, take the green eye shades away from your eyes and be conservative. Be very conservative. I want to buy one further out of the money. I buy a 1200 put, but my net credit is $2.80. $2.80. I'm probably going to get out of this before it gets even close to expiring. Ed says, sorry I'm late. Will this be recorded and given out? Yes, it will. Investors Inspiration puts together the whole packet and will send to anybody that has signed up. So you'll be getting that. And I think they have about a week delay on that, Ed. but yes, you will be getting the recording. This is a bull put risk profile, and basically the red line here says that if it drops to that price, that's the max you can lose. This is the max you can gain, okay? And the white line is the P&L for the day. So that's this. I constantly are managing the risk profile, and you pretty much can do this, you know, once or twice a day, period, end of sentence. If it looks good, you carry on with what you're doing. This is a great money generator. Okay, a bear call is just the opposite. A bear call is used when you think there is going to be a decline in the price. And for a bear call, what I am doing is I am selling a call out of the money. At the same time I do that, I buy one further out of the money. Now, you don't want to do these separately. You want to, whatever trading platform you use, you want to go in and you want to select bear call, bull put, vertical spread, whatever they have there, and put those in together. You want to sell one and buy one simultaneously. Do not leg into this. Do not leg into this, because if the market goes against you quickly, you can get hurt. You want to have that protection built in as soon as you get in there. Okay, here's just an example on Google, the one you just saw, and what I did there is I sold the 580 call and I bought the 590 call. Okay, and that gave me a credit of $2.20. Okay, and that's how to set these up. And here's the bear call spread risk profile, and this is how you manage the trade. Okay, an iron condor is an advanced option trading strategy utilizing both the bull put and the bear call, selling them together, okay? And that's what's called an iron condor. If you remember the risk profiles, here is the bull put risk profile. Here is the bear call risk profile. You put them together, here's your profit zone right in here, okay? And it's called an iron condor because it kind of looks like a bird ready to take off, okay? I like iron condors. It's the first thing I look for because it doubles your credit. Okay, in this example, the example we just looked at, if on the bull put side, if you sell a put and then buy one further out of the money, you got 85 cents credit. In the bear call, you sell a call and sell one further out of the money. Okay, remember, you know, the ones you're selling on the put side are higher than the ones you're buying, and on the call side, the one you're selling is lower than the one you're buying for protection. And now I've got credits of 85 cents and $1 or $1.85, which, you know, doubles what you can get. Not always do we have iron condor potentials, and I will show you that. Okay, this particular chart, what I want to show you is this was a bull put that was put on right here, okay? Then it went up, and that's great. That's great. It's a bullish strategy. Whoops, but then it came down. Then it came down a lot, and this probably would shake out a lot of traders. And then what happened is it turned around and it went back up. Now, you know, I use Fibonacci's, so I could have pinpointed this, but let's take a look at this. With a bull put, which is a bullish strategy, at 0.2, this strategy was up 38%. And then we had a crash. But at 0.3, I was still profitable. And then I finally got out when it hit this one, and I exited with 84%. This is the beauty of a vertical spread. Pete's saying, do you usually use vertical spreads of 10 points? Yes, I do. And that's one of the things I'm going to be talking about when I talk about mitigating the risk. It gives you good credit. And really, Pete, when I put on a vertical spread, I don't expect it to go against me. I'm really putting that on. It's almost like, do you not have health insurance? Okay. And do you expect to use health insurance? No. But when it happens, you're glad you have it. Okay. I've found out through my years of trading that 10 points on the big boys gives me great credit with great risk mitigation. Good question. Good question. Okay, let's look at the same thing on a bear call. Okay, got in right here on a bear call, went with me. Then whoops, it went up. A lot of people would have gotten out there. Over the 20-day exponential moving average line, not looking good, and then all of a sudden, whoosh, down it came. Okay. So probably if you had a put here, you would have been flushed out. You would have been flushed out for sure. With a bear call, which is a bearish strategy, at 0.2, we were up 67%. At 0.3, we were only down 21%. And that is reasonable. You have to allow these trades to work. And I have rules as to when to get out. 21% I am going to accept. Finally, we exited down here with 100% gain. Okay, it gives you time to let the trades evolve. I always trade the big boys, and the big boys are the ones that are $300 per share or greater. And what I did when I put this chart together is I did bull put spreads, 43 days left, and I went for a selling a delta of 0.10, 10-point spread. Amazon, Google, and the RUT, you can see, gave a credit spread on that bull put of about $1. Okay, look at these guys. Okay, DuPont, Nike, Verizon, Starbucks. The ones that are around $50 to $100 just don't give you that credit. Yeah, you can buy more, but when you buy more, you're paying more commission. Why do that? That's why I stick with the big boys. Stick with the big boys. I stick with Amazon, Google, and the RUT, and I never trade these going into earnings. Never. How do you mitigate the risk? Well, you stick with the RUT, Amazon, and Google. Just like Pete was asking earlier, I go with a 10-point spread. I enter about 40 days. Now, that's not, could be if I see something I like, 43 days. If I see something I like, 38 days, no problem. I always go at a delta of 0.10. And by the way, the delta means that it's got 10% chance that it's going to get there. Well, that's a pretty, if I'm investing against that, that's given me a 90% chance of being correct. That's a high probability trade. Now, I always exit when I get plus 10% of my margin requirement or minus 6% of margin, which is 100% and 60%. This is about, this strategy is right about 75%, which is unheard of. It's unheard of. If you cut your losses and take your profits, when I'm looking at here, over the long run, you're going to be very consistently successful. As soon as it hits these, if it's down here, I'll look at it and I say, can I make a case to stay in a little bit longer? Do I see support? Do I see resistance? Does it make sense? And sometimes I do stay in a little longer. Same thing is true on the upside. If I'm roaring through and looking good, and it's got it right in the middle of Fibonacci's, and it's got a little bit more room to run, yeah, I'll let it go. But I'll keep a close eye on it. That's when I keep a little bit closer eye on it. But as soon as these happens, I get out, and it limits the time in the market. I very seldom go any tighter than 2 weeks before expiration. So 40 days to 2 weeks before the market is kind of my window. I don't like to get into that 2-week zone because things get pretty volatile and pretty risky. When you get this and get out, don't be greedy. Take it. Thank you, market. I know you're tough. And thank you for that, and I'm out. Okay. The two things that I use, actually the three tools that I use a lot, are, first of all, the regression channel. The regression channel is calculated. This is the regression line. The regression line is calculated by taking 50% of the price above and 50% of price below for the 6-month time period. I used to do this by hand every night, because it was the regression channel is the most powerful tool I think is out there. That and the Fibonacci's. Nowadays, this is a thinkorswim, any platform pretty much is at a click. At a click, you can put on a regression channel. Now, if this is the regression line, which by the way is a fantastic trend line, because 50% of the price is above, 50% is below. If it's sloping up, where are we? It's bullish, okay? The green line is the +1 and the -1 standard deviation. +1, -1 standard deviation. The gold is +2, -2 standard deviation. 65% of all prices will be contained within this. 95% of all prices are contained within this. It's kind of like the casing on a sausage. The meat's going to be contained within here. It gives you a great overbought, oversold look at the market. Okay, here's some actual trades. Got in on this one on March 8th on the RUT, got out March 22nd. Back here, this is when I made the trade. Okay, it was right here. I love this support right here. Love this support. It was definitely bullish. Okay, you can see how the Aroon was pegged. What I did is I sold an April 110 put and bought a 1000 put for $1.70 worth of credit. I exited with 45 cents on the table for 125% return. These are actual trades of the RUT since October 2015. This was an iron condor I put on down here for 105. This was a bear call. This was a bear call. This was a bear call. Why were these bear calls? Well, it was up in the upper channel of the regression channel, okay? And it was starting to go back down. Bear call. Here's an iron condor. Here's a bull put. This is a bear call that didn't work. Yeah, sometimes they don't work. Here's a bull put that did. Here's an iron condor that did. Here's an iron condor that didn't. Okay? You look at those and you say, well, okay. And the reason why I hung longer than I usually do with these, I did. And shame on me. Because if I would have held just a little bit longer, it would have worked out just fine. But I, you know, to be quite honest with you, I had a tremendous run, and I was so flush that I let this one go for a while. And yeah, I've been doing this for 35 years, and yeah, I still make mistakes. Here's an actual trade I made in Amazon. Got in June 30th, got out just after 4th of July. This also was a bull put where I sold. See, notice how it gapped up during the earnings. Okay, I set this up looking at the window. Okay, we got some support here. We got some support here, some support here, big support here. Here's where I'm going to put this on. sold the 650, bought the 640 for $1.50 credit, exited with 85 cents debit. Exited with 85 cents debit. I didn't like what was going on, and I'll show you. Okay, 65% return. All right, Google, June 28th through July 19th, just recently. It was down here to the -2. It was out of the casing of the sausage, if you will. It's what I call an outlier. Does it happen sometimes? Absolutely. Absolutely. I look at this thing as the regression line as a big magnet. The further out it goes, the harder it wants to pull it back, and most times it overshoots. And then it pulls it back again and it overshoots. And then it starts settling down a little bit, okay? This was an outlier. I felt really good at putting on this bull put and watching this go up for 170%. Now, this is the independent back testing of the RUT for 10 years that was done by one of my. How far out of the money do you go to put on your spread? Usually I go, I'll look at a delta of 0.10. Then I'll come back to the chart and I'll look for support and resistance and kind of modify that. Okay, I can't go into all the rules right here today. However, they're all right, they're for free on my website, and I'm going to show you that in a second. This was an independent back testing from 2003 to 12, and what he came up with was an average win of this per month. It was 75% average winners per month for 10 years. That's the kind of information you can bank on. Okay. Renee talked about, I love Dr. Van Tharp. I've learned a lot from him. He's written a book. It's a great book. He's a psychologist that works with traders. He talks about financial freedom as really a new way to think about money. Most people think they win the money game by having the most money and the most toys. Financial freedom means that your money's working for you, and it makes more money than you need to meet your monthly expenses. Wouldn't that be great? Wouldn't it be great? And that's a reasonable goal for anybody. And now you can kind of sit back and say, well, what kind of strategy can I use to accomplish that? And that's what this is all about. It doesn't mean you won't spend hundreds or even thousands of hours building your foundation. Absolutely. This is easy strategy, but it's hard to master. Take the time to master it. It's not going to go away. Okay, I'd rather have, you talk to a lot of financial planners, they say, well, you can't retire now, you don't have X millions of dollars. I'd rather have consistent cash flow than a large amount in the bank. All right, so you want to learn more. All right. What I want you to do is go to www.optionsinfinity.com, www.optionsinfinity.com, and I want you to become a free member. I want you to learn how I trade. How do I trade? Okay, so let me bring this up. When you come into www.optionsinfinity.com, what I want you to do is scroll down to this section right here where it says, I want to learn about what you do and become a free member. All I need is your email and you're a free member. Once you're a free member, you have instant access to my 3 trading strategies: swing trading, credit spreads, weekly options. You have free access to an Options 101 course, options leverage, how I pick my stocks to follow. The chart setups I use in Thinkorswim. What's your proper trade size? Talking a little bit about the psychology of trading. Here are some of the indicators I use, all right? And so much more. Now, I want to go further. The first thing I want you to do is sign up for a free member, okay? Learn about this. See if it makes sense to you. Just recently, I put the best of my three strategies together in what I call the SPX, because I only trade the SPX, S&P 500, weekly option regression, SPX war. Click on this button, learn more. What it's going to do, it's going to take you, and right now the program's closed. It's closed. However, I'm going to open it up for you guys. But I want you to learn about me first, so there's no hurry, okay? This is going to tell you about everything about what the SPX, how I started doing this, what tools I'm using, all that kind of stuff. What it gives you is 4 video courses on exactly step-by-step how you do that, but I'm going to send you real-time email alerts telling you when I am putting on a trade. Okay, it's when I am putting on a trade. Then once a month we get together for a Q&A session. This is the equity curve for my SPX trading. This first portion here was paper trades. Then I got into real money, and this has been the real money performance since then. Okay, very low drawdown. This is over a let's see, I think it was less than 2 years trading. Less than 2 years trading. Okay. However, for you guys, well, how much is this? Well, it's $247 and then $97 thereafter to get the real-time alerts. I'm going to send you real-time. I'm going to teach you how to do it. You want to do it on your own, fine. But the first month, I'm going to send you real-time alerts. You want to continue with the real-time alerts, go ahead. What I want you to do is, if you like me, if you like what I teach, if this makes sense to you, go ahead and put your name in here. And what it's going to do is give you $150 off and allow you to enter this program August 15th. When you put your name in here and your email address, you will get an alert. And Jurgen says, yes, I'm in. That's great. Thanks. Thanks. You will get an email that gives you the code that when it opens up, and it'll tell you, you'll get an email saying, okay, we're open. We're open. We've got a limited space for 20 people. I don't want this to be a huge thing. I want the people that I have, I've got time to give them one-on-one attention, and that's what this is all about. Okay. But the first thing I want you to do is go back here and come into Options Infinity and be a free member and listen to me and learn for free. Okay?